Folks, welcome back to another Bear Tracks report. Hamilton here with the Trading Initiative. On Thursdays, we like to look, even in bull markets, at the worst performing stocks in the market. In bear markets, or when we start to go through corrective phases, having a list of the weakest stocks when the market is strong is helpful. Generally, because when the market starts to chop around, or God forbid, we do get a trend reversal, when we do, we're already going to know which stocks should lead to the downside. Yes, folks, weak stocks in strong markets tend to be leaders to the downside in weak markets. Whether or not you want to characterize the last 2 weeks to 4 months as a weak market is completely up to you. I believe it's a weak market. We're still of the opinion that we are in a primary uptrend before we get into the thick of this. We are in a primary uptrend as of right now. This market is in a corrective phase. It does not appear to be breaking down yet. And so the overall objective should be looking for stocks that are showing relative strength, because you will assume that the market resolves higher over time. Now, right now, the market is guilty. It needs to prove to us that we want to be net buyers again. We haven't bought anything in tech or consumer discretionary in quite a while. As a matter of fact, we're looking to short. As of right now, we're at the bottom of a range. I think the markets are overexposed right now. People are getting chopped to all hell, trying to time the bottom. I think before we start here, I just want to point something out from a sector standpoint here. If we go and we look at yearly trends, worst performing sectors of the year, consumer discretionary and tech. I think it's absolutely crazy for people to be buying dips in these two areas of the market until there's some sort of evidence to support that a low is in. And as of right now, there is no evidence from my perspective that a low is in two of the higher beta areas of the market. Consumer discretionary and tech are still underperforming everything else. And so minimum, if you're looking to go long the areas of the market that are not underperforming. Things like consumer defensives, right? Or consumer staples, things like healthcare, materials, real estate, communications, to a lesser extent, financials are still outperforming the S&P 500. But buying these high beta breakdowns, I think, is crazy. All right, I'm just going to throw that out there. First things first, you can see the Bear Tracks report. Think about the names that were on the list last week compared to the names that are on the list this week. Last week, we had names like Target. We had names like Abercrombie and Fitch. We had names like Ingersoll. All of those, really quick, just to point out, did break down. Right? So going back to Thursday of last week, we got the breakdown in Target. Had supposedly good earnings, but some bad guidance moving forward. We got the move that we were looking for in Target. We got the move in Ingersoll Rand. So you can see we broke back down below our risk off level. We were able to take a little bit of profit. Now we're right back up to where we were. Is this a potential re-entry on a short? That's not on the list, so we're not going to talk about it today, but it's something to think about. Abercrombie and Fitch, we got a huge gap down. So those were the three that we were really eyeballing last Thursday. All three of them, with the broader market, came down. The last one that we talked about last week was Microsoft. Microsoft, we liked below 390. We have a put debit spread on this right now with the stop in place. We're not stopped out yet, but this hasn't broken down. So maybe that's information we need to take forward when thinking about whether or not this market is actually going to roll over. Microsoft is the weakest of the Mag 7 stocks, and for whatever reason, it started to break down and then caught a bid. This is information we have to take into account. Is this actually a topping pattern, or is this a scoop and score? Is this a bear trap? Okay, so those are the four that we talked through in length last week. This week has a completely different vibe. Look at the types of stocks. Last week was dominated by tech and retail. This has a lot of oil and gas names. Folks, if you didn't catch the tweet that I sent out yesterday, the worst performing sector during the first Trump administration was energy. The worst performing industry groups during the first Trump administration were oil and gas, exploration and production, and oil services. He's on the podium screaming, drill, baby, drill, and the stock market is screaming, sell, baby, sell. If you're buying stocks based off of what politicians are saying they're going to do, you're a sucker. Do you want to know the two best industry groups during the Trump administration's first stint? Solar and clean energy. Pretty much the exact opposite of what you would expect. The reason why I point that out is, once again, we are seeing energy potentially lead to the downside. We're seeing a lot of names, a lot of 50-day lows A lot of 52-week lows come in on this particular part of the market. That was the trend during the first Trump administration. Could that continue this time? I think that there's definitely a possibility there, folks, so keep an open mind. Go ahead and look through the list here. You can see some of the names. You have Dow, which has absolutely shit the bed for a while. AMD, which has been hands off for a long time. Arguably the weakest of the major semiconductors. I think this one topped the most and has frustrated the most amount of people because it just hasn't caught a bid in, I think, almost a year now. It's just been absolute shitter. Continue to go down the list. And one that we really like here is Builder. So let me build this case for you, no pun intended. Go ahead and remove some levels here. Builder, if you think about the grand scheme of things, the market in general, home builders. Home builders were the first major industry group to bottom in 2022. They bottomed in June, I believe. This is before semiconductors. This is before some of the names that normally we would expect. Tech, consumer discretionary, generally those areas bottom first and then start to rally higher. It was home builders that rallied first, and they carried this market all the way through the middle of 2024. Then we started to have a little bit of a hiccup. We had questioned this particular leadership group for the last 6 months. Is it still in a capacity to lead? Well, I think it's in a do or die situation right now. And remember, primary trends in the major indexes remain up. So while these are guilty or they're innocent, they're not guilty until they fully roll over with indexes rolling over as well. Okay, I just need to point that out. Right now, these are not guilty. They're innocent, meaning this looks like a topping pattern, but it very easily could be a bear trap into a rally higher. We see it all the time in bull markets. So these are just levels of concern that we're looking at. If we're below the key levels, there's an opportunity to short. If we're above the key levels, we have to go back and rethink our thesis. This is actually a top. Now, right now, we know market sentiment, and everybody is screaming that this is a top. I don't think it is. I don't think this is a bull market top. So when we're approaching these shorts, we want to approach them with some rationality. Where are we within the broader market? Where are the indexes? What is the supporting evidence telling us? As of right now, it is verifiably okay to open some tactical shorts. So BLDR, home builders are starting to roll over, the entire industry group. BLDR gives us an opportunity at owning one of these particular names that has what we like to call capitulation zones. Capitulation zones give us a high probability setup that we're going to get a 2 to 3x ADR move, which is your average daily range, within a single trading session, right? That's what we like to sell our puts into. It's just a really quick bump down before a potential rally back towards the original breakdown level. Particularly since we're still in a primary uptrend. We're not going out and buying puts for 6 to 12 months out. I don't think this is going to zero. I don't think this is a bull market turning into a bear market yet, right? The markets are still innocent until proven guilty, and as of right now, they're still innocent, even if it's just by a hair. BLDR, I like this sub 130 with a price target somewhere in between 110 and 100. I think the biggest problem, and I said this last Thursday as well, is that people tend to overstay their welcome in these short positions. They assume that if you're going short, you think the market is going to zero. You think this company is going to zero, and that is absolutely ridiculous. It's probably not going to be zeroed out. So when we take these shorts inside of TTI, we take them aggressively, and in this type of market condition, we take short-term aggressive positions, looking for capitulation moves. There's very little volume here to support the fact, is this actually going to be a big breakdown? Are there going to be buyers stepping in? The way we like to look at this is we're trading below a downward sloping 200-day moving average, which automatically you have to assume you're in a downtrend as your primary trend. This is a downtrend here. We have a series of lower highs. We have price trading below a 200-day moving average. That's typically characteristic of a downtrend, right? We have very poor momentum, right? We like to use the RSI to gauge momentum here. This is a bearish momentum regime. We've tapped oversold multiple times. We have not tapped overbought. Bears are in control. Key level to short off of, nice big round numbers, somewhere near 130, 131. And we have a free fall zone verified by previous levels, right? In an uptrend, this was a higher low, so we can assume that there might be some buyers there. And we verify how much volume is in between the pocket. Pocket meaning from the risk on level to the target. Is there a lot of volume here? Well, if we scroll all the way over and get all of this data in here, we can see that there's not a lot of volume in there. A majority of the volume is up here, and down here, meaning this is an opportunity to short this particular vehicle for a short amount of time with a higher probability chance of a capitulation, excuse me. You don't have to hold these things longer than maybe a couple days or a couple weeks. We don't think BLDR is going to zero. But we do think that on a technical basis, this chart may have higher probability of a bigger, more aggressive, explosive move to the downside in the short term. So BLDR, it's in the right industry group, right? ITB, home builders starting to roll over there. Previous market leader. Higher beta, by the way. If we go ahead and throw our daily stats indicator on, it's a 3.59 ADR. So this isn't a slow mover, which is great. Higher beta, trading below a downward sloping 200-day moving average within a bearish momentum regime. We've already gone through earnings. I think there's an opportunity here to get some short-term short exposure on BLDR. That's it. It's just a quick little trade. So I like BLDR here. I also like potentially First Solar. We've made a bunch of money to the long side of First Solar. But First Solar now is coming into an area of contention. As a matter of fact, I would prefer to buy First Solar here than short it. But I do think if we break down below 125, 123, something like that, there's an opportunity for this to potentially give us a 5% move lower and then a little hook or a scoop and score, excuse me. I like this particular setup more from the bull side. If we do find support here off of this proprietary gray box, which is simply the 2021 highs, I think there's an opportunity to own this. And remember, what were we just talking about? During the first Trump administration, the best two performing industry groups were solar and clean energy. First Solar is, drum roll, a solar name, right? So thinking about this in the bigger picture here, key levels, we break down below 120, 123. There's an opportunity for a potential 5 to 10% move, aggressive move to the downside. This is high beta as well, but I'm actually looking more for a potential bounce here. I don't think that's out of the question. Look at all the different oil and gas names on here. We were talking about that, right? A lot of different oil and gas names. I'm going to key in on one of them right now that I opened up. We have a couple energy shorts on the books right now. One that I personally like is ConocoPhillips. It's on this list. It's just we try to limit this list to 30. And there's so many weak stocks right now that this one is probably lost in the mess, right? I really like ConocoPhillips for a short, not necessarily because I think oil is going to zero, or not because, energy is going to zero, but because I feel like this is a overexposed topping pattern, once again, that there's a high probability chance of a capitulation down below $90. I think $90 is kind of that risk on, risk off area. As long as you're below $90, there's a reason to be short. If you're back up inside of this range that we've been in for the last 2 or 3 years, I think you get out of this. I think there's an opportunity here for a quick capitulation. That doesn't mean this is going straight to $50. It doesn't mean that it's going to zero. It does mean that you might get a 5 to 10% move over a 1 to 2 day period where you can sell those puts into for 50 to 100% or whatever they go to. This is a very clear risk on, risk off level for me. We're below a downward sloping 200-day moving average. We're within a bearish momentum regime. Going back to May of 2024, oversold, never got back up to overbought. We've been range bound and coming down. And also there's no volume into this pocket down towards about $70. So there's an opportunity, I think, to short this thing in the short term from about $90 down to potentially, I don't know, 80, 75, 70, depending on your time frame here. And it wouldn't be the end of the world, by the way. And it does coincide with kind of that energy weakness that we were just talking about in the first term of Trump's administration. And there's a bunch of different types of trades here. You don't just need to take kind of the big names. There are some names out there that are floating around on FinTwit right now that everybody loves to buy, and I think they're going to get burned buying dips in the short term because the technicals match up to some high-flying short setups available. And I think in the short term, while indexes continue to stagnate across the lower bounds of the range, I think it gives individual stocks an opportunity to really get crushed in the short term, particularly higher beta stuff. There's a whole slew of names. I'll give you an example. Of stage 1 into stage 2 breakouts. We can use ARK as an example. Stage 1 into stage 2 breakouts. This is a fantastic way to get long a market. I mean, it's beautiful. But as it was originally written up, a lot of these stage 1s into stage 2s eventually come back and retest their original breakout spot. It happens. It happens so frequently that the author, Stan Weinstein, that kind of pioneered this version of the stage cycle, he was not the first, right? Richard Wyckoff, and before him, Charles Dow. He said that most of the time, these pull back in towards the original stage 1s. And this is ARK, and you know what ARK represents: higher beta FinTwit favorites, your Teslas, your Palantirs, your SoFis, etc. Right? It's pulling back and retesting. This uptrend is still intact as long as you're above 53. Right? As long as you're outside of the range, trading north of an upward sloping 200 moving average, this is an uptrend. No matter how you want to spin this is an uptrend on a technical basis. There are lots of stocks that look just like this, just like ARK, same characteristic, but they're still hanging out up here. They have yet to come down and retest that stage 1 breakout. I'm not going to show you the ones that we're in right now because it didn't make the list, and that's not fair to the people that are inside of TTI. But I think that it's worth a scan if you're looking for some short-term short exposure. Look for the higher beta stuff breaking down that might not have yet come back and retested at stage 1. And I guarantee you, there's a lot of FinTwit favorites on that list. And if they do pull back, you're going to see a lot of cope. But in reality, once again, on record, I want to say, as long as you're trading north of range high and an upward sloping 200 moving average, I don't care how much destruction there is, that is still a primary uptrend. And that should still be looked at as more favorable long than short over the long term here. So ARK, to me, favorable risk to reward here, potentially from the upside. I'm not going to get into it because it has nothing to do with the Bear Tracks report, but I would be going and looking for those higher beta trades that have yet to pull back to the stage 1 and are sitting kind of in la-la land. There's a lot of empty space below them. So once again, here's the report. I encourage you to go through these types of stocks yourself. I encourage you not to short strength. I encourage you to look at weak stocks. If you're looking to short, we had a great conversation inside of Discord about why we don't want to short strong stocks. It's not that they can't go down when the entire market's coming down. It's they typically underperform weak stocks going down. And if you're inside of TTI, we want to make the best possible decision whenever we can, not just make a couple bucks, right? All right. Answer any questions really quick if there is any, because I have a couple minutes. Made bank on BLDR, hell yeah. It's such a right? Well, to be fair, I don't know if you're talking about long or short, but you're right. We went long this as well at one point. AZEK as well. This was a great trade in both directions, I think. I think right now there's an opportunity for a short-term breakdown in BLDR, but once again, if you're of the mind that this primary uptrend in the bigger picture, as in bull market, is not over, it's hard to imagine home builders completely rolling over here. This is just a tactical opportunity to get some short exposure in a market that looks like it wants to screw as many people over as possible before potentially going higher. That's how I'm viewing the market. Like I said, I think the overall market is innocent until proven guilty. And while we're pretty close to being proven guilty, the supporting evidence is starting to support being guilty. Until we break below key levels and a 200-day moving average, I will remain steadfast to the system, which says primary uptrends should be viewed as opportunities to buy strong stocks more so than shorting. Okay, that's how it works, guys. My name is Hamilton. I'm here at the Trading Initiative. Robin, always nice to hear from you. If you like this type of content, please like and subscribe. Leave a comment below. Let me know what you think. Is the market getting blown out? Are these stocks about to reverse? Some jackass last week said that the Bear Tracks report were longs last week. I hope you longed everything and lost a bunch of money. See you tomorrow.